Here is a number that sounds like a warning but may be the opposite. Foreign investors now hold the smallest share of Indian equities in about 2 decades. India's own central bank flagged it in a financial stability review. After years of relative underperformance and steady outflows, the foreigners who once set the tone for this market have quietly stepped back. And yet, over the very same stretch, Indian benchmarks kept climbing, closing higher for a 4th straight session this week. A shrinking foreign presence and a rising market at the same time, that combination is not a contradiction. It is a clue about who really moves this market now, and that is what we will unpack. Why does ownership matter as much as price? Because in markets, who already owns a thing tells you how much fuel is left to move it. If a group is heavily overweight, they are the crowd that can sell, and heavy selling is a headwind. If that same group is underweight, two things flip. There is less of them left to sell, and there is more room for them to come back and buy later. Positioning is not a forecast, it is a description of the fuel in the tank on both sides. Read it that way, and today's low foreign ownership looks less like an exit and more like a coiled spring. Look at how far the retreat has gone in specific names. In HDFC Bank, one of the market's largest stocks, foreign ownership has fallen to around 38%, down from roughly 44% back in 2014. In it sits near 12%, down from about 19% just 2 years ago. Across a basket of heavyweights, foreign positioning is described as sitting at a 2-decade low, leaving stocks like Reliance, Infosys, and Larsen & Toubro visibly underowned by global funds. This did not happen in a crash. It happened slowly as foreign money chased other markets and trimmed India on relative performance. The result is a market whose biggest companies are lightly held by the very investors who used to dominate them. So the question becomes, if the foreigners are not the marginal buyer anymore, who is? Here is the mechanism, one block at a time. Block 1. A stock that global funds have already sold down has a smaller pool of foreign holders left to sell. The most eager sellers have largely gone. That thins out one source of downward pressure. Block 2. On the other side of every trade this year has been a domestic buyer. Indian mutual funds, fed by monthly retirement-style flows, have been absorbing the foreign selling almost trade for trade. When one large seller meets a patient, mechanical buyer, the price does not have to fall much for the shares to change hands. Block 3. The quant wedge. This flips the usual crowding logic. A crowded, overowned stock is fragile because everyone who could sell already owns it. An underowned stock is the reverse. Light foreign holding means a smaller marginal seller today and a larger potential marginal buyer if sentiment turns. None of this guarantees direction. It simply changes the balance of who is positioned to push and in which direction the path of least resistance runs. You can see the handoff in the flow data. Domestic institutions have poured more than 4.73 lakh crore rupees into equities so far this year, a wall of steady buying that met the foreign selling head-on. That is why, even with foreign ownership at a 2-decade low, the Nifty sits back above 24,400 and the market has strung together gains. The people hurt by the foreign exit were not domestic investors who kept buying. They were the funds that sold India cheap and watched a domestic bid carry it higher. The ownership of this market is changing hands from foreign to local in slow motion. So the next time a headline warns that foreigners are fleeing Indian stocks, hold it up to this lens. Ownership sits in one of two regimes, crowded and overowned, where the risk is that holders sell, or underowned and lightly held, where the fuel is that absent buyers can return. India today sits closer to the second. That does not tell you what the market does next week. It tells you where the pressure is coiled and who the marginal buyer has become. Watch the flows, not just the headlines. If you want more breakdowns of the machinery underneath the market, subscribe for the next one. This has been educational content, not financial advice.